Yeah, so I suppose the premise here is you think your super's going tax-free to your loved ones when you pass away, you probably should think again.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Exciting news, Ben. So the first bit of news before we get into some financial planning topics is that Burke Britton is a major sponsor or naming rights sponsor for the Geelong Young Professionals event. It's happening Thursday, the 27th of November, 2025, at the brand new, how do you pronounce this?
We're going to go with, it's got to be Geely
dealership, just down the road in Gordon Avenue. We had to check that, make sure that was spelt right, but it is. So it's a nice new electric car dealership down on Gordon Avenue. So it should be a fantastic night. I think we're going to have 100 to 150 young professionals that don't think we're invited, Ben.
I say we might be outside the realms.
We're just
snuck out.
I think as a naming rights sponsor, you get a Guernsey, but it'll be a great night. GYP always put on great events, and I think we haven't sponsored a GYP event for a while, but looking forward to it. We've had a long association with Geelong Young Professionals since we used to be once.
You were a founding member.
Yeah, founding member of the GYP committee. I think we had I had 3 of the committee members on one of the podcasts, so we might put that in the show notes.
Beautiful. They're always good events. It's a good way it's an easy networking event. Everyone's in the same boat, so make sure you get along and support it.
So if you're a young professional in Geelong, don't miss it. Go to gyp.net.au and RSVP, get your spot there. Should be fun. All right, now we're going to run this episode a little bit like the one we did a couple of weeks ago. We're going to keep the topics short and sharp, and probably a bit of a teaser on a couple of areas that we've found clients being interested in, or we're getting lots of inquiries around these particular types of issues. So let me talk about the first one. You mentioned this morning redundancy, and I had a sort of question here. So sometimes redundancy can feel like the closing of a door, the chapter's closing, and a lot of questions about are you prepared and what to do with a redundancy. So maybe the question is, what is a redundancy for those people that don't know what a redundancy is? What is it? What types are there, and what are the thoughts and questions that you should be thinking about if you get a redundancy?
I think obviously it's a word people have probably heard of, but yeah, there are some complexities to it, and there's different forms of it. So in simple terms, a redundancy is, someone's been made redundant is their position no longer exists, would be a very simple definition in my mind. Now, that can happen to whole teams at times. It can be just a role. It can be differing scales. A lot of people look for them and hope for them near the back end of their work career, but they also can come at times where they're unexpected, and that's probably where I think advice around that is even more important than otherwise. So again, there's voluntary, involuntary, and sometimes there's sort of, and the ones I've dealt with recently, there's probably a blending almost of the two, where you've got people who can get a choice, or they can sort of roll the dice on another role. The key thing I find with them is talking about it as early as possible, as soon as you know that there's a chance. And understanding where you sit. So for clients who are ongoing clients, they've already sort of got their head around where they might be at and what may happen. For a lot of the time, we see redundancy as a trigger to seek advice, which is challenging a little bit because we haven't got that background of where they're at already. But we can quickly get up to speed with that and understand, okay, what does this mean? So I'm not sure with your experience with them. I've had a run of them recently, and probably with state governments trying to save some money, we'll probably see a few more.
I was just going to say, you see them mostly at the moment, you're seeing them mostly from state government and larger corporates. Like the voluntary or involuntary redundancies, they tend to be with larger corporates or government agencies, yes?
Correct. And the thing with a lot of those guys is they've been there for a very long time. So then they have... there's different calculations and methodology that goes into them. There's sort of some standardization of that, and then there's some tax benefits. So often you're finding people who have done 15, 20, 25 years service, being offered a redundancy package. And I think that the part, and I think you mentioned this in your notes too, is just the emotional part of that. So people are emotional, which can be challenging. And there's emotional tie of going, they know what they know. They've been there for 25 years, or I think I might hang around. I'll put in for the limited offers that are there. But trying to remove the emotion and just say, here's the facts. Like in some of them, you might be looking at 2 years net pay paid out to you in one lump sum. but you were going to retire in 3 years anyway or 4 years anyway. So then you've got to try and sort of run back and work through the numbers on it and make a decision around it. So there's obviously always a financial component and there's always an emotional component. And we need to weigh all those things up. And pretty much my view of it is just gather the facts and do, again, as we always say, you do your stock take on where you're at. Now, in a recent run I've had of them with one state government department, like you've got 4 or 5 different people all at really different phases of their life. So it means completely different things for all of them. And even the decision that we help them make around accepting the redundancy or trying to retain their position, like we can help guide that.
So let me fast forward to someone who's actually made the decision. You've helped them. They've said, yes, we're going to take the redundancy. I'm pretty sure I know what your answer is going to be. And it depends, but give me some hypotheticals on what you're seeing people do with their redundancy. I don't want you to say just it depends, but give me some of the examples of how you've helped people make that decision of where that money goes.
I think the most common one is that, and this is something that you would see in the news, is that more and more people are getting closer to retirement with a debt. So often extinguishing debt if you're not going to roll into another job. And it depends on the sort of debt. So debt is nearly always one component of that situation. Then there's obviously the taxation of it. Is there any benefit of putting some to super, or is there something that can be done to mitigate any tax on it? Often it's trying to get those funds then repurposed for investment and starting to give them some income. Like if they're going to be then maybe taking a pay reduction or ceasing work altogether, they need to get those funds doing something for them. So it usually ends up being a multitude of different things. It might be also they haven't had a long holiday in a while, they're going to take 6 weeks off and go overseas. Like we would encourage them to take that break, use these funds for an opportunity to pay for something like that. Maybe they need to get a new vehicle. It's trying to set yourself up. Often when you get those lump sums, it's going like, right, let's knock a few things on the head that we need to do quickly, that we don't want to harvest from our investments or other sources later on too. So trying to maybe bring forward some expenses and actually just knock them over and do them, and then position yourself for that next phase. Again, it depends. You've got people getting made redundant at 35 or at 60. Like it depends greatly. Debt is probably the consistency across nearly all of those people, though.
Yeah, most people. And again, that also opens up some opportunities. I think that's probably coming in our next couple of topics around what you can do if you are paying down debt. But last question on redundancy. What are the things you discourage people to do if they've got a redundancy?
I think it's probably the opposite. That's just actually talk about it. So don't hold it in or don't let it get too close to the wire. I've seen where people have known about it, but then they've let it get within 24 hours and then they've gone, I've got to make a decision. So don't sit on it, act early and speak and find out the information. As soon as you think there's a chance, maybe start to just do some research and try and find out, what does that mean or what could it mean? Because you got to sort of flip the script in a way, because most people view it negatively because they feel like, oh, I wasn't required, or I haven't done a good job, or they're getting rid of me and I've been.
A bit emotive.
There's a lot of emotion. So you got to flip it and go, okay, well, it is what it is. But if I chose to just walk away from this job because I didn't like it, I would walk away with basically nothing. Essentially, you're getting paid to leave. So there is a big silver lining. And then you flip it and go, now what can I do with that? What's the opportunity on the other side of it? So,
and like we've talked about plenty on this podcast, our superpower is the fact that we're detached and can help people look objectively, do that stock take. So I suppose the call to action, if you're out there and you're facing redundancy, address it early, reach out and talk to us. We're unemotional. We'll be able to sort of point you in the right direction around the next steps and give you a sort of a clearer path on the future. All right, next topic, Ben, and this is one that I think it took a bit of a hiatus for a number of years. The question is around margin lending and potentially a resurgence of margin lending. Is margin lending making a comeback? So markets are on the move. Some investors are looking to be more aggressive, and sometimes that follows market being really good. People want a piece of that action. But the question is margin lending right for you? Now, if I go back to it's sort of global financial crisis times, Storm Financial, I think, are we allowed to use?
I don't
know. I think they were found guilty, so I don't think we need to say alleged or anything like that. But there's some significant misappropriation of sort of margin lending and leverage, which I think put a pretty reasonable hiatus on margin lending as a strategy and as a method of sort of leveraging and growing investments. But maybe let's just start with what margin lending actually is, and then we'll talk about why potentially it's maybe gaining some more popularity and who it might apply to. So let's start with, do you want to have a crack at what margin lending?
So this is more your wheelhouse in a way, because I think about when you talk about it is I'm authorized to do it and I have clients who have done it, but it's not something that's been very flavored.
So let's think about how if people are borrowing for investment purposes, most of us, and I think it's our next topic, but most people, if they're thinking about borrowing for investment purposes, they're thinking about potentially using the equity that they have in their home to invest in some shares or managed funds or something like that. But what margin lending is essentially being able to use things like cash, managed funds or shares, and then have a provider. And there are a few out there. There used to be plenty, then there was not many, and now there's a few more coming back onto the market. But actually using those cash, shares, or managed funds as security, so borrowing against it, like you might borrow against your house, to actually have some additional funds to invest in the market, so into shares, managed funds, and the like. And so the idea of leveraging is basically using someone else's money, so the bank or another lender's money, to invest in the market and sort of magnify your returns. The obvious, maybe it's not so obvious, but the obvious benefit of that is that you can magnify returns. The obvious negative of that is that on the downside, you have the significant potential to magnify losses. So I've got a few clients at the moment where margin lending we've deemed it appropriate for a couple of reasons, and those reasons are they maybe are not wanting to, for a number of reasons, use the equity that they have in their home, or it doesn't exist, but have really substantial cash flow and have assets, managed funds, shares that they could, if they wanted to, use as security for borrowing for additional investment.
I think it's just another tool that it's not one that you would use for a lot of people, but there is a bundle of people or a small tranche of people who it is appropriate for. But then even then it needs to be entered with some caution and process. I suppose the downsides of these facilities are usually higher interest rates, like higher than what we would sort of deem as mortgage rates and things like that. So they're relatively expensive. They need to be structured correctly. They need to have some buffers built in, both inside the investments and outside, to extinguish any shortfalls. So they do sort of narrow down. I think that the other thing that, from my view of why people don't go down this path as well, is that there's a lot of sort of off-the-shelf investments or products who internally borrow for you now. So you can go to the market and buy like an ETF, GEAR, so GEAR, and I'm fairly sure it's just like if you put $100 in there, essentially borrow another 100, invest 200. So without
I think we looked this up the other day,
documents, didn't we? And without a heap of things, you can actually gear your exposure and double your skin in the game without having to go through a whole lending approval process. So I think that's another reason that sort of has watered it down. I don't think that those style of investments are appropriate for everyone also, because there's also some other taxation issues with them that aren't as favourable. So again, like everything, as boring as it is, it does depend. And that's the other thing. So margin loans have been competing more so with banks doing other lending options. Equity's been strong in homes because there's been a lot of property growth. Rates have been high, so it's made it look unfavourable. And then there's been an influx of new products and offerings. It doesn't mean they're obsolete. Like I think, like anything, it's probably narrowed how many people they're appropriate for,
which I think is a good thing, because I think it was sort of positioned as something that was suitable for everyone, and the reality is that it just isn't. And like anyone thinking about, they've got shares, they've got managed funds, and they've got they're on a reasonable income, good surplus, looking for potentially some additional tax relief. You probably should be having a conversation about whether or not a margin lending strategy might be appropriate. But again, there is a number of risks to mitigate in all of that. And unlike using the equity in your home, and we'll get onto our next topic in a second, but unlike using the debt in your home, the bank, if you're using your own home equity, they're not going to come after you when the shares decrease in value below a certain level. With a margin loan, we have a horrible thing called a margin call. And a margin call is where the margin lending provider says, these shares have decreased to an extent where we want you to either do one of a few things. We either need you to give us some more money, pay some money off that loan, need you to add some additional funds to those investments, or we're just going to sell your shares. So that's why if you don't have a strong surplus, if you don't have a good strategy, margin lending is definitely not for you. However, if you have those things, you should definitely talk to us and see whether or not it's a strategy that fits.
The other flag, which I think is probably one that doesn't get utilised enough on margin lending, is if we see often coming out of estates or different methods, is people receiving like a really large bundle of one share. Mm-hmm. So, and I'll use Commonwealth Bank as the example. Their mum and dad bought it at listing and have let it DRP and dividend reinvest and build over time. Now they've inherited $500,000 of Commonwealth Bank shares. Now, if they sell them, they're going to get whacked pretty hard with the tax man, but at the same time, they're extremely overexposed to one business. So you can actually use the borrowing against those to build diversity. So instead of having to sell those shares to buy others, you can use that as a leverage point to then borrow. Now, you might not go and borrow another $500,000. You probably wouldn't be able to, but maybe it gives you the ability to borrow a small amount to start to diversify and then maybe sell them down over time. So it can be also a lever that accesses diversification and frees you up as well. And I think that's where it probably gets underutilized, to be honest.
And I think it's also should be noted that the strategy of margin lending can be at many different levels. And I think where I've seen it work best is similar to how we invest with a lot of other people. That's by averaging into the market and doing it in installments. So it doesn't need to be an all or nothing thing. It doesn't need to be secure. You know, you've got $1 million worth of Commonwealth Bank shares and they're going to lend you, $500,000 to invest in the share market. No, you can invest in installments. You could invest, a couple of grand a month, 10 grand a month over time, mitigate that risk. So I suppose the call to action here is that margin lending, I think it is for a lot of reasons making a bit of a resurgence, but it's not for everyone. And a couple of those examples, if you've got shares, managed funds, cash outside, and you're on a good income, you've got a good surplus, you probably should have a chat with us and see whether or not that strategy might be suitable for you. All right.
Debt. It's the flavour of the day.
Well,
debt
it is.
Recycling.
Well, debt and sort of borrowing for investment purposes. We've seen property prices increase. We've seen a lot of clients and potential clients come to us with large amounts of unused equity in their properties. This idea of debt recycling, I've had the question probably 2 or 3 times over the last week around what debt recycling actually is. So the question is, what if your home loan can help you build wealth instead of it just draining your bank account? I didn't write this. That's the power of debt recycling. I don't really like that hook, but let's roll with it anyway. So in simple terms, Ben.
Well, I was thinking about, I suppose, if in like all strategies, is going back to why. So why would you debt recycle? The purpose of it is to extinguish your non-deductible debt quicker. So if people lose track sometimes of why they would debt recycle. So if you go, okay, come in and you've got a home loan and you're paying a lot of interest on it, all that interest is non-deductible debt. So it's debt you can't claim as a tax deduction at tax time. So people go, how do I get rid of my mortgage quicker? The simple traditional way was you just put all your surplus to it and you kept knocking it down. Now, most of the time you still want to do a good chunk of that. But what you might also do is use some of the equity in your property to create investments and then create returns to speed up that process and pay down your non-deductible debt quicker. Now, by borrowing with the equity and investing it, any of the interest associated is a tax deduction, which means the net interest rate is much, much lower. So you've got to get that right. You've got to get your timing right, your structure right, your ownership right. Now, a lot of people debt recycle, and a lot of people have done it from what I see and have spoken to people about based upon their own research and content. And even what I see from a lot of the content is I actually think they do it wrong. Mm-hmm. So people think that you borrow to buy income-based investments to generate more income to then redirect towards your home loan, which I think is actually fundamentally incorrect. Like, I don't think that I've seen people do it, but you start to water down the tax benefits, which is one of the big upsides of the strategy. So where it gets complicated is what do you invest in and then how do you realize those improvements in value to speed up the debt reduction process. So I think a lot of people have got their head around the concept in a way, and they want to explore it, but most people still do it wrong.
Well, I think there's variations with anything. Like debt recycling is a pretty broad term, but I've seen it described in a sense of without the final conclusion of paying that non-deductible debt off. So the example I saw the other day was, let's assume that every month your home loan comes down by, well, let's say every year your home loan comes down by $20,000, and in simple terms, as that home loan, that non-deductible debt reduces by $20,000, if you have your loan structured right, you take that $20,000 and you borrow it back and you invest it. And that $20,000 that was previously non-deductible now becomes deductible. Those funds are then invested into some asset, whether it be, more than likely, preference would be to growth assets that are generating more than the interest cost. But I have seen it presented in a way that actually doesn't, it disregards altogether almost that idea of having to make a decision about whether or not you direct income or sell assets to put off your non-deductible debt. So in simple terms, that's the idea of using the equity as you create it to turn it into deductible debt. But I think your point's a really important one. Where do you invest it, and then what do you do with it?
I think it's about creating. I use the term very specifically returns. I don't use the term income, because I think that's where people go wrong. Is they go and buy a heap of dividend-based investments, which pay them dividends, which offsets the deductions from the interest, and you end up in a tax sort of neutral scenario. Whereas if they invest in something that was a growth asset and it grew in value, and then after 12 months they sold some, and then they got a 50% CGT reduction, and then they took the profit to pay down the non-deductible debt, we've just added so much more benefit to that strategy. And people are still getting benefit on the other method, but not as much. And I think that's the key, is that you have to get that whole piece correct. And that it's a big risk mitigator. If you get the strategy and the structure correct, you bring down your overall risk, because you don't need to generate as much return to break even. So then you're making a profit in a much easier sense. Again, I love the conversations about it, because people are thinking about it, and pretty quickly you sort of draw a little bit on the board, and it's very much where I get my whiteboard marker out to draw it. I think it's getting more utilized, but still not at its best. It's something I do often with clients. But again, it comes back to appropriateness. It's not for everyone. Borrowing money, when people think you can borrow money to create more income to help your lifestyle, you're going to have some issues there, most likely. It's not necessarily the way you go to generate more income.
And if you're borrowing for investment purposes, arguably, people who are doing that probably have got to have a reasonable level of income to begin with, and they're just tipping additional income on top of their already reasonable income and creating a greater tax issue. And this is where there's a few different levers in the whole use of equity, debt recycling, how you invest, what you invest in, when you pay it off the non-deductible debt, and even, like you said, the implications of how do you mitigate the tax on a capital event. Selling after 12 months, maybe things like offsetting it with losses, offsetting it with other deductible expenses. So, last question on this. So, I know you're going to tell me it depends, but who's a debt recycling strategy most suited to?
I think when I talk to clients about it, you obviously sort of work through a bit of a checklist. So they have to have good cash flow. Generally speaking, the higher marginal tax rate, the better. So you need at least one member of the couple, if it's a couple, to be on a relatively high marginal tax rate. That will make the strategy more effective. You need time. So they need to be probably, you're not going to start doing it if they're 59 and retiring in 3 years' time. You need duration, like any investment, because you need to invest in growth assets, risk assets. So again, it always needs time frame. So good cash flow, high marginal tax rate, long-term time frames, and probably just an overall, I think, which is maybe not a tangible thing, but educational understanding and knowledge of what's going on. Like, we need to educate them. And sometimes I won't introduce this strategy for a year or two because I don't think people are ready, or maybe longer, or maybe not at all. Like, maybe it makes sense from a pure numbers sense, but are they equipped to handle if there is a bit of volatility?
Would you say that this is a set and forget strategy?
No. And that's the thing, is this is one that needs maintenance. And again, people love this idea of passive investing. I don't think passive investing and debt recycling really pair together very well.
Yep. I like it. So, call to action for those people out there thinking about debt recycling is that it can be a great strategy if done well, but requires plenty of planning and plenty of maintenance. All right. Last topic I've got here, Ben, or I've had clients say to me, is we have death tax in Australia. Death tax. And I don't know, how would you answer that?
I say yes, which most people go, oh, what do you mean? Well, it's like I think I said the term beneficiary tax to you the other day, which, again, it's got a few interchangeable terms. I think this is becoming more topical, and it's in the media a lot more, and people are starting to clue on to the fact that, especially when you talk about superannuation, that there's definitely a risk that you're going to get some clawed back to the ATO. And it's nice and tucked away, and that's why no one talks about it. Yeah.
So I suppose the premise here is, you think your super's going tax-free to your loved ones when you pass away, you probably should think again, or you probably should have a look. Most of the time,
what is, and I say this to clients all the time, is that most people just never knew or didn't realise. So traditionally what would happen is, one mum or dad pass away, then all the money goes to the survivor, and then the second of the couple passes away. Now, the kids receive a call from the solicitor and a distribution of their estate funds. What they don't know is how much tax was clawed out of that first. And they go, oh, thanks, mum and dad, I got 150 or 300 grand. They didn't know that the ATO already took 80 grand. Because they just didn't know, and it doesn't bother them because they just never had an awareness of it. Now, I think even the solicitors are getting better at communicating that as well. I had a client last week, and we'd completed a strategy for her mum, and loosely it was probably a $50,000 upside in the estate. And we knew mum was unwell, and we knew that she was starting to get a little bit more progressive with her illness. So we sped up the last bit of the strategy, and we got it done quickly. And she passed away it was weeks, not even months after we completed it. And the solicitor said to the 3 kids, like, well, you're lucky, like this was actually done. Because most of the time it's not, because a lot of people don't know about it. They haven't asked questions, they haven't done anything. So those kids were pretty happy that there's an extra 40, 50 grand left in the pool. That otherwise would have just simply gone without there's no other method to get rid of it.
So let me try and simplify this with some really round numbers that we never normally see. But this idea of the sort of the beneficiary tax. So it is, so if a death, and we've had a podcast on this before, so we'll find that and add that to the show notes as well. But it is very, very topical. So if a death benefit from superannuation is paid to a non-dependent adult beneficiary.
Which is most of the time, to be honest.
Yep.
Nearly all the time.
So hypothetical client, they've got $1 million in super, and it's all taxable, so it's all of the contributions over their working life. And their only beneficiaries of their super or their estate are adult children. That taxable component, if it goes to the kids, is going to pay.
If it goes directly to them, 17%.
Yeah, so it's 15% plus 2% Medicare levy.
And even small strategies is you can get that to 15 quite easily. With more time and more detailed strategy, you can get to zero. Yes. If you get to zero on any of it, every time you do $100,000 of it, you save $17,000.
Yeah. Well, it's $170,000 in that example, and you have clients as well where significantly more than that, where the potential, and you said before that I think solicitors are doing a better job of explaining. I think we're doing a better job with clients of explaining, because people work their entire life, they accumulate their wealth with a view that they will benefit from it, and what's left their kids will benefit from. And most of them are just not aware that the government at the tail end is going to take 15% plus Medicare levy. And just, I know it's not on our run sheet, but if you happen to have some life insurance in there, is going to cop 30% plus Medicare levies. That's a decent chunk of what you think you're going to leave to your kids.
The example I used the other day for a client was, so all of those contributions as they go in, the ones that your employer makes, the ones you make as salary sacrifice, there's 15% as a minimum coming out of that on the way in. Now, if at the back end, another 17% comes back out of those funds, you've actually paid 32%, which is ballpark probably the average marginal tax rate. So if you think about it, as super goes in and super comes out, it actually all levels off in the end. But no one thinks about it like that. Like, you're actually just paying basically the average marginal tax rate on your super by the time the tax a bit on the way in and tax a bit on the way out,
just a little
unless you interact with it and make some changes.
It is a bit confronting when it comes out in a lump sum, though. Like but
most people don't see it still, because it goes to the solicitor and it goes to their trust account and they pay it. Like, even the $1 million scenario, and most people are emotional, they've lost a loved one, but they get, 300 and something, nearly $300,000 still, which could have been more. Like, it could have been a fair chunk more, like an extra 170 each way. Like, there's another $50,000 each. So they still feel like, like they're appreciative, but what they just didn't know didn't hurt them. And that's sort of how it's sort of structured.
Well, I think our job is to make
sure
people
it's
aware.
Yeah, definitely.
And maybe before we close this one out, let's talk. And I know we've talked about this previously, but what are some of the strategies broadly that we can do to potentially eliminate that? And again, every client situation is different, but what are some of the strategies? And again, it's not so recent now; it's probably 2 or 3 years ago that the contribution rules changed for people older than 65. But let's talk about what are some of the strategies in simple terms you can do to eliminate that tax.
So, as the person who holds those funds, drawing them out, taxable or tax-free means nothing once you're past 60. So they can draw those funds out. Now, hypothetically,
so tax-free to them.
To them, into theirs. So there's no earned income tax on drawing it down. There's no cost to them. So they might choose to draw down actually a large amount of their super. Like, maybe they might take $100,000 out. And if they then put that back in and redeposit it as after-tax savings or after-tax funds, it goes back in. They don't pay any taxes, contribution tax, and now that's created what we call tax-free component. Now, that tax-free component can do whatever. It can grow to whatever figure down the track, and it will never become taxable component again. So it seems backwards, and people always sort of look at you a bit funny, or they think that it's like money laundering, but you often take the money out of super and put it back in. The other thing is that, like, super is the best tax environment for most people for a good chunk of their life, but in their latter years, it often can actually start to lose its benefit too. So sometimes actually exiting the superannuation environment can actually be the best thing for people. So I often say to clients, like, through their early years, super's not that exciting for them. It's good from a tax point of view, but it's a long way away. Then you sort of go through that middle phase where it's not too far away, it's the best tax environment, and then into retirement, usually best place. And then as they age, sometimes that can start to deteriorate again, and sometimes super in the super environment can actually become less desirable. So our job is to be square with that all along the way and understand what suits that client's needs. Sometimes it's keeping it in super till the day they die. Others, it's actually removing it from super and investing it in a non-super environment for them.
I think this is that idea of cashing out. So cashing out super, and sometimes that's it might be age, it might be health dependent. I know we've had a number of examples where the decision around whether to move money out, because we've got some awareness around someone's time left on this planet. The other strategy broadly that we can use, you mentioned it before, is we call it a sort of cash out recontribution. That strategy was difficult to apply a couple of years ago because the rules didn't allow people between 65 and 75 to be able to put money back into super in this recontribute strategy without meeting some form of a work test. That work test doesn't exist anymore. So I suppose my one of the call to actions there is that if there are people out there that haven't even asked the question about, what would happen in the event that my super went to my adult children, you've got to ask the question. And if you're in that ballpark age of from 60 to 75 and you haven't thought about it maybe you should ask the question, should talk to us about it. So probably that call to action is don't let that your legacy get taxed unnecessarily. Again, come and talk to us. Do you want to add anything further?
No,
Ben?
I think it's just never too late to ask or never too early to ask that question, because even people who, let's say they're in their late 50s and they've received a lump sum and they think, oh, I've paid off my mortgage, I'm not far from retirement, I might put that into super. There's still reasons why you might be better placed to have actually multiple super funds and start to actually divide up your benefits. And multiple super funds is like a scary thing for people where they think it's double the fees. Most of the time, there's actually not, if you're using the right product and platform and structure. So again, just get advice. So I had to simplify it. Just anytime you're thinking about making any change, especially of significance, is just ask the question.
Yeah. I like that. I'm going to ask you to just explain that, the separation of super funds. Just explain it really simply, why you would have two super funds.
Okay, let's say you've got $300,000 in super. That's all of your works, savings, your super guarantee, salary sacrifice. All of that component is taxable component. And now you've received $300,000 inheritance and you're thinking, I want to add that to super. If you contribute that into the same super fund, now you've got a super fund that's 50% taxable and 50% tax-free. Every time you draw money out of it, it comes proportionately across the components within. Now, that's not a huge drama, except the fact that now to actually remove that $300,000 of taxable component, you've got to draw out all $600,000. Now, hypothetically, you open up a second super fund beside it and you keep the two taxable components side by side. They've still got the same purpose and they're essentially sitting with almost like an invisible line between them. You get to that point where you decide, okay, I want to try and remove this potential $41,000, 17% beneficiary tax from the other side of it, then you will actually, $51,000, pick that up and remove it on its own, put it back in, and then merge the components and live happily ever after. So if you don't split them, there's a lot more work to do. And often then that's when contribution caps can start to chew you up.
Yeah, I like that. And I think we've thought about multiple self-managed super funds are a great mechanism to be able to split, accounts, different pension accounts potentially with taxable components. But we're seeing it more and more now because products allow us for people to have multiple different accounts. And you'll see on a lot of our policies where you go online and it's got taxable and tax-free. We've separated. And
sometimes you have taxable, tax-free, and the blended. The
blended, yes.
Like you actually end up with three. And don't get me wrong, like three is pointless unless there's purpose, like most things. So you need to know why you've got three. And sometimes clients go, can you just remind me again? And you do quick, yeah, that's right, I remember, all good. It makes our job, we can do a lot more things for a lot more quickly to wash away that tax if we do structure it correctly from the outset. Yeah. Otherwise, it's one of those things you can't unwind.
Yeah, and it speaks to a lot of our thought process around thinking deep into the future for clients and not being purely transactional, but thinking beyond just the immediate contribution and how this is going to impact not only them, but their kids and their grandkids. All right. Thanks, Ben. We've knocked off 5 topics in quick time. Hope that was helpful for everyone. We'll see you next week. We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.